What if you could invest in stocks that provide a near guarantee of regular dividend payments and continual income growth? Income you can rely on month after month to pay your bills, potentially allowing you to live off your investments. That's something you can achieve by investing in this exclusive list of companies. Let's take a look at exactly what dividend kings are and how you can use them to maximize their effectiveness for the highest return on your investment. Pay attention because although they have the potential for extreme profits, there are some pitfalls. A dividend king is a company that has consistently increased its dividend payout every year for a remarkable period of at least 50 years, which is twice the duration needed to earn the title of a dividend aristocrat. This extended track record often indicates that these companies boast substantial competitive advantages, creating barriers to entry and enabling them to generate consistent and predictable profits. With pricing power on their side, they can adjust prices in response to market dynamics, like rising costs and consumer demand. Additionally, the management consistently chooses to distribute profits back to shareholders through dividends, rather than keeping them for reinvestment within the company. Dividends provide a sense of stability for investors as they can count on the income consistently, at least to some extent. When the share price of a stock and the market in general rises and falls day after day with constant swings in price, dividends are paid regularly, and in the case of dividend kings, for 50+ years. This steady, reliable income is especially desirable for people who are retired and like to know when their next dividend will arrive and exactly how much it will be. The income received can be spent to pay bills and other expenses. Even if share prices drop drastically, the need to sell off shares during a market correction is eliminated. In most cases, dividend stocks don't provide the highest returns for investors, mostly because the companies are older, mature, and fully grown, but that doesn't mean they can't be lucrative. The mental impact of dividends is also a large part of their popularity. Successful investing hinges on the ability to remain committed for the long term, resisting the urge to succumb to panic and trusting the investment process. Adhering to these principles is easier said than done given the volatility of markets. Regular dividend payments serve as a powerful psychological anchor. Witnessing these dividends flowing in on a quarterly basis not only contributes to a sense of financial stability, but also creates a calmer state of mind. The assurance provided by consistent dividend income makes it much easier for investors to stay composed, relaxed, and accomplished, all of which are critical factors for long-term investing. Many dividend kings consist of consumer staples, industrials, and utilities, which are all companies that see consistent income regardless of economic factors. Currently, there are 54 dividend kings, some of which are common household names which most people have heard of. Lowe's, which currently pays about a 2% dividend, Pepsi paying about 3%, Kimberly-Clark at almost 4%, AbbVie paying a little below 4%, Target paying above 3%, and Altria paying nearly 10%. Among others. Many of them are less common names that most people wouldn't recognize, such as Black Hills Corporation, ADM, and RPM International. You can find the whole list of stocks by doing a quick search online. One key metric that's especially important when it comes to dividend stocks that will give you a glimpse into the overall health of a company is the payout ratio. The payout ratio is a percentage of a company's earnings that's paid out in the form of dividends. Generally, it's best to see a payout ratio below 50%, with a range of 35 to 55% considered acceptable. The payout ratio for Altria is currently around 80%, and the share price is currently about the same as about 10 years ago. Investors should also consider the earnings growth of a company. Has their earnings per share been growing consistently over the years, and is it expected to continue growing? Steer clear of companies that are unlikely to increase profits. Consider the stability of the industry in which the company operates. Industries with consistent demand and economic resilience are more likely to support reliable dividends and price appreciation. Examine the company's competitive positioning or the moat it has, which provides protection against competition. When dealing with dividend stocks, it's wise to take a page from Warren Buffett's playbook and invest in areas you're familiar with. Rather than gambling by putting your money into a company in an industry you know nothing about, it's smarter to focus on companies you understand well. For instance, if you're a regular shopper at Lowe's and have a solid grasp of the home improvement industry, you have insights into the company's operations, including store efficiency, cleanliness, and staff quality, all factors influencing its success. Being familiar with the company and industry allows you to gauge consumer behavior. Are people spending money on home improvement projects? Are they actively engaged in fixing up their homes? Investing in what you know not only aligns with Buffett's advice, but also empowers you to make more informed choices based on your first-hand understanding of the companies and industries involved. Don't be quick to assume that a stock labeled as a dividend king is automatically a lucrative investment. Some stocks flaunting exceptionally high dividend yields do so because their share prices have been on a continuous downward trend, lasting for years or even decades. Consider a scenario where a stock offers a tempting 10% dividend, but if the stock price consistently declines by 20% each year, the investment won't prove profitable. Moreover, these stocks might carry a risky payout ratio, raising concerns about the company's long-term financial health. It's crucial to look beyond the title and carefully evaluate the overall financial picture before jumping into what might seem like a high-yield opportunity. Even the mighty dividend kings aren't immune to the ups and downs of the market. Just because a company holds the prestigious title or consistently pays reliable dividends doesn't automatically make it a risk-free choice. These stocks face the same market volatility as any other stock, and the pressure to continually raise dividends introduces additional risks not shared by regular stocks. Essentially, the management might feel the pressure to keep those dividend payouts flowing, aiming to uphold their coveted dividend king status, even if it means potential financial troubles down the road. When you invest in these stocks, you're not just banking on the market's belief in them, you're also relying on the management to sustain their performance, which when it comes to dividends, can be a tricky balancing act. To broaden your horizons, explore the dividend aristocrats, companies that have consistently increased their dividend payments for 25 consecutive years. While this alone might be an impressive feat, albeit not as impressive as the 50 years in order to achieve king status, there are still some exciting opportunities elsewhere, stocks that aren't on either of these lists. Not every company attains the status of a dividend aristocrat or king, but that doesn't mean they're not reliable dividend payers. Many excellent dividend stocks exist outside of these lists. Whether a company opted not to increase its dividend to navigate financial challenges or had to reduce it as a smart financial measure, such decisions can indicate responsible management. It's important to recognize that absence from these prestigious lists doesn't necessarily imply inferior investment potential. There are many instances where companies exhibit many signs of high-quality investments despite not holding the title of aristocrat or king. Regardless of a company's status of king or aristocrat, what investors should be seeking is high-quality businesses with excellent fundamentals, which are the main factors influencing long-term stock performance. Dividend kings can be a promising way to secure a steady income and financial stability. These companies with a 50-year record of increasing dividends suggest that they've got a strong game with competitive edges and reliable profits, and in many cases, they really know what they're doing. There are some tricky parts, like the mental roller coaster of market ups and downs and the risks tied to enticing dividend yields. You just have to be cautious and do some digging, checking out stuff like industry stability and how good the management team is, while not becoming starry-eyed at a dividend yield. It's all about finding that sweet spot between a reliable dividend that will pay your bills for a long time, while also buying a stock that's going to increase in price.